Hello, welcome to my talk. Here I am again with more information on stock. This is the end of chapter 2. So it's on stock valuation. So we learned a little bit about stock and how it's, if you want to go not risky, you go bonds, but stock is always a good choice if you want to make money big. But it's a lot more riskier because as you can make money big, boom, you can lose it all really fast. So only invest what you're willing to lose, but think, positive thinking, that it's gonna go up. So today is about stock valuation. The way to make money with stock is to buy it when it's lower, when it's cheap. So I really don't understand a lot of these. I have to go into it more and become more knowledgeable, but I wrote what I kind of understood about it. So there's a couple of ways. Let's see, 1, 2, 3, 4 ways to check valuation on stock, which again, I read it, I wrote down what I thought I read, but I need more information on this. You guys might understand it more, but I'm not very good with money and formulas and all that good stuff. So plus and minus is my forte. Anything other than that is stresses me out, and I don't like to be stressed, so I stay away from this, but it's part of it. So if you want to invest, you need to know these things. So I'm just gonna read like usual, and here it goes. So it's PE, price to earning ratio. Generally speaking, stocks are cheap at 6 times earnings and expensive at 23 times earnings. See, I get 6 is low, 23 is up, but I don't understand earnings. But keep going. It's important to know if the market is on its way from 23 to 6 or vice versa. And just, I'm trying to learn. I'm trying to get, knowledgeable about this. So I listen to this thing in the morning, and right now everything is down. Everything is going down. So I don't understand if it's a good time to buy since it's down, or I don't know if it's going to keep going down, but it's not a good situation right at this today moment. Then the other thing is price to book value. It is an estimate of the fundamental value of the companies from an accountant's point of view. So the price to book value is an accountant's point of view. Net assets after all debt is subtracted. So they do with the money, the whole thing that the company's worth, minus everything they owe, and that is their net assets, like what they really are worth after all of their debts are subtracted from the company worth. That's price to book value. And then dividend yield ratio. All you have to do to determine dividend yield is take the current annual dividend and divide it by the stock current market price. Most reliable, per author's opinion, indicator of the reasonableness of a stock's price. So dividend yield ratio is the most reliable per the author. So maybe we should learn a little bit more about that, because I didn't understand what I just read. But I guess you determine dividend yield, take the current annual dividend and divide it by the stock current market price. That is the formula for this baby. Dividend yield ratio. The last one is price to sell ratio. By dividing the amount of sales by the number of shares the company has has outstanding. You get a sales per share figure. To get the price to sell ratio, divide the sales per share figure by the stock's current market price. If the price to share ratio is below 1, that indicates pretty good value historically. What that means, I need to read more about it, because all these, you know, I know this is what you do to get the stock valuation, to know when it's cheap or not cheap, so you could invest, but I don't get it. So hopefully you got a little bit, at least you heard what these are: the price to earnings ratio, price to book value, dividends yield ratio, and price to sell ratio. Now I like, it talks about the types of stock, so I'm gonna go ahead and do that because I thought that was cool. So types of stock, there's big cap, small cap, and foreign stock. So the big cap, we had read in the previous book, they gave us a list of 30 like big companies like Disney and you know, Walmart, and what else did they give? I don't remember, but you know what I mean, right? The big Coca-Cola, Pepsi, all those big companies that are big and that will most likely never fall. Those are big cap company. And so the one thing they said, and I don't want to look for it, but it said General Motors, it had the saying that before they used to say, if it's good for General Motors, then it's good for the country. So that's how much they relied back then on these big cap companies. Like if General Motors or one of those big companies is doing it and it's working for them, that means, you know, everybody should try that, because that's a good thing. So I thought that was really cool. And then there's the and you know, those are the companies to invest in, but they're already priced high because they're big cap companies, they're important companies that will not fail, so they don't grow as much, but they don't lose as much either. So that's the least risky of your stock, actually. And then the small cap, they're really good because they're small, they're new, they're hardworking because they want to get big, and so it's really good to invest in them because they're working hard, so they're going to grow bigger. And in the book it says that it's sometimes better to, if you're looking to win big money, to work on the small cap or invest on the small cap rather than on the big cap, because they start small, they're going to go fast and you're going to make a lot of money. But as they grow fast, if they don't become like a big cap company, they also will at one point, you know, maybe die really quick, where you would lose all the money fast too. So you have to, if you're investing in stock, you have to be there, like watching it every day. They talk about it in the news all the time. So yes, this is something you will have to be like stressed about all the time if you decide to invest in these. And then there's the third, which is foreign stock, which they also say is very good because I guess it's less expensive and they try new things. So it's good to invest if you're trying to make money, like big money, and foreign stock. But you know, depending on how it's going, if there's wars or their government is going loco or whatever, you know, it's up and down. It's very, and that's the most risky, but you could also make big money on that. They said something about that too. Let me read that. It's at the end of the thing here. The most practical way for Americans to invest in foreign stocks is either through a foreign mutual funds offered by a brokerage that specializes in this area, or to buy what are known as American Depository Receipts, ADRs. These are receipts for shares of stock in overseas companies held by American banks. Purchasers are entitled to all dividends and capital gains just as if they were holding the actual share. Like U.S. equities, returns on foreign stocks are taxable by Uncle Sam. So everything is taxable. So and then it goes, I don't know if to make another video on getting information on stock or if I should just read it here. But I'll just give them to you because I haven't read this, but it's getting information on stock. And I know they talk about the Wall Street, New York Stock Exchange, which is NYSE, American Stock Exchange, AMEX. The newest kid on the block is the NASDAQ, National Association of Securities Dealer Automated Quotations. And it says how to read the exchange. Maybe I should do another one of this. The Dow Jones Industrial Average, DJIA. Oh, they have a lot. Standard and Poor's, we talked about this earlier. They're going into explain what they are and what they do. Yeah, I'll do it next week. I really wanted to go to part 2, but I'll do getting information on stocks next Thursday. So we'll have one more on stocks, and then I believe it's going to move on to bonds again. But I thought it was really interesting. I really enjoyed this second part of the chapter. It's really interesting, and it's like easier to, you know, save money to buy stock. Like I said last time, I just bought the stock for my Beachbody company that just went public last week. Yeah, and so I bought 12 shares, and they cost $12. So this is more doable, but it's riskier than bonds. Bonds, you know, you have to save $1,000. But you know, I'm trying to get there too. But for now, I started playing with a little bit of money because it's $12 and I only bought 12, so I only invested like $120, $130. But that's the good thing about stocks, and my view is that if you're, you know, willing to play slowly, then you are able to. It's doable, and all you have to do is open a little account and Ameritrade, or what is it that I have? Shoot, I forgot what it's called that I have, but it's doable. Stocks are fun. It's just don't do too much unless you're willing to, you know, especially if you're not that knowledgeable yet, which is where I'm at. That's why I just did a little bit, but okay, that is it for today. See you guys next week. This was fun, and so next week is information on how to get the information on the stock. See you later.